Every major crash in history, think 1929, 2008, it always creates two very different groups of people. One group panics, and the other, well, they quietly get rich. And the really unsettling thing, a lot of analysts believe the next one is already forming, with a potential reset hitting right around 2026. So today, we're going to dig into why they think that, and we'll look at the two radically different playbooks that are emerging for how to handle it. One sees a generational buying opportunity, and the other is all about protecting everything you've got. Yeah, this isn't just some old saying. For a growing number of people watching the markets, this is a potential roadmap for the next few years. They see these crashes not just as moments of total destruction, but as moments of profound change. Really, the single greatest wealth transfer events we ever get to witness. The big question is, which side of that transfer are you going to end up on? So here's how we're going to break this all down. First, we'll dive into the historical patterns and the hard data behind this whole 2026 crash prediction. Then, we'll look at the two completely different strategies people are talking about, either treating a crash like a massive clearance sale, or, running for a safe harbor. We'll compare them side by side and then wrap up by framing the choice everyone has to make. Is it going to be panic or is it going to be preparation? Right now, there's this really strange feeling in the air, isn't there? The stock market is hovering near record highs. But underneath the surface, the actual economy is slowing down. We're seeing layoffs, and these super high interest rates are just squeezing businesses dry. Analysts have a name for this. They call it the late cycle illusion. It's that final, almost euphoric state where the market's optimism totally detaches from what's actually happening on the ground. Now, what's really fascinating about this slide is the historical argument. For over a century, the American economy seems to follow this weirdly predictable rhythm, usually driven by these long-term debt cycles. About every 18 to 20 years, the whole system just reaches a breaking point where all the crazy speculation and debt just slam into mathematical reality. You can see the pattern right here on the timeline, and it kind of suggests we are due for the next big reset right around 2026. So that sense of unease, it's not just a gut feeling, and it's not just some historical theory. No, it's backed up by cold hard data. Several key indicators that have pretty much always preceded major crashes are, right at this very moment, flashing bright red. Okay, let's start with the first one. This is famously Warren Buffett's single favorite way to measure market valuation. It's actually super simple. It just compares the total value of all stocks to the size of the actual economy, the GDP. Think of it like a price tag for the entire market. A ratio of 100% is considered, about right, fairly valued. So where are we today? We are at nearly 200%. That is almost double what would be considered fairly valued. The last two times it even got close to these levels, devastating crashes followed. So this isn't some little yellow warning flag. This is a massive, flashing red light screaming that we are in extremely overvalued and frankly dangerous territory. And it's not just one metric either. The Shiller PE ratio, which looks at stock prices compared to their long-term earnings, is telling the exact same story. We are currently at the second highest level in history, and the only time it was ever higher, 1999, right before the dot-com bubble burst. But here's what might make this time different and maybe even more dangerous. See, unlike 2000, which was mostly a tech bubble, or 2008, which was a housing bubble, analysts are calling this the everything bubble. Debt has just exploded at every single level. Consumers are racking up credit card debt just to keep their heads above water. You've got a huge number of zombie companies out there that don't even earn enough to cover their interest payments. And the housing market, even more expensive than the 2008 peak, but now with these crippling 7 or 8% mortgage rates. The overvaluation is literally everywhere. Okay, now here is a really common and potentially catastrophic mistake people make. A lot of people think, oh, as soon as the Fed starts cutting rates, we're safe. But if you look at history, it shows the exact opposite. The major crashes often begin after the Fed starts cutting. Why? Because the cuts themselves are a reaction. They are a sign that the economic damage is already done and the system is already breaking. They're not preventing the fire. They're the fire department showing up after the house is already burning down. So, with the Fed's usual safety net looking more like a warning siren, we've reached this critical fork in the road. While a lot of sources agree on the problem, they totally disagree on the right way to react. One group sees a once-in-a-generation buying opportunity just over the horizon. The other group, they see a time for extreme caution, for protecting every single dollar you have. All right, let's explore that first school of thought, the aggressive opportunist. This playbook looks at a potential crash not as a crisis, but as a massive wealth transfer event. When the panic starts, they don't see danger, they see a clearance sale. This quote from John D. Rockefeller just perfectly captures that mindset. I mean, while everyone else was getting ruined during the Great Depression, a small group of people who kept their cool were buying up the core assets of the American economy, railroads, oil companies, for pennies on the dollar. They were literally buying the future at a staggering discount. So the crucial takeaway here is that this isn't about getting lucky. It's about having a plan. First, you've got to master your own mindset. You have to train yourself to be logical when the whole world is emotionally screaming sell. Second, you build up your dry powder, your cash. In a crash, cash becomes ammunition. Third, you make your shopping list now, in the calm before the storm, figuring out which high-quality companies you'd love to own. And fourth, you execute with patience. You don't try to time the absolute bottom, you just buy in stages as prices fall. And now for the complete opposite approach, the safe harbor. This strategy isn't about trying to get rich, it's about trying not to lose what you've already got. This is the playbook for the cautious defender, especially for anyone who is near or already in retirement. And this really highlights the huge difference in priorities. You know, for younger investors, there's plenty of time to recover from a crash. But for someone who's nearing retirement or already in it, a major loss could be a fatal blow. Recovering from past crashes has taken over a decade. So for this group, the number one goal is protecting what they have. So, what does safe even look like in this playbook? Well, it means moving your capital to ultra-safe, liquid assets. We're talking about things like short-term treasury bill ETFs, high-yield savings accounts that are FDIC insured, actual US Treasury bonds, and money market funds. The goal is dead simple. Preserve your capital and just wait out the storm. Okay, so we've got these two completely different philosophies. Let's put them side by side and see just how differently they would approach the exact same market. This is basically a tale of two portfolios. Just take a look at this, it's wild. For the opportunist, stocks are something you buy on sale. For the defender, you get out of stocks. The opportunist sees a crash as the perfect time to scoop up prime real estate from people who have to sell. The defender avoids anything they can't sell tomorrow. But what's really interesting here is how they both view cash. To the opportunist, cash is just temporary dry powder waiting to be used. For the defender,